This digital classroom started with one man and a chalkboard before conquering an entire nation. It weaponized the noble pursuit of knowledge into a high-stakes corporate gamble. Because behind the glossy purple screens hid a fragile empire funded by predatory loans and shocking duplicity. This global edtech giant fell from the zenith of education to scandalous financial ruin. Its name, Byju's. Welcome back to the Flop Side, the podcast where we uncover the stories of Indian startups that once soared only to come crashing down. I'm your host Priyanka, and last week we followed two brilliant founders into the hyper-pressurized world of Y Combinator. Watch them build a genuinely impressive AI tool only to be swallowed whole by pivot hell. This week, we are going to a very different scale. This story isn't about a startup that burned away its runway. This story is about Byju's, a platform with a beautiful origin story that genuinely helped millions of students understand math and science in a way their classrooms never could. A company that at its absolute peak was the highest valued startup in the country. But somewhere between the beautiful origin and the breathtaking peak, something went very wrong. You think you know the story because it's been in the headlines, but the underlying mechanics of this meltdown are absolutely mind-boggling. So buckle up. This is going to be an extra long, extra turbulent ride about the painful journey from Blackboard to bankruptcy.
Act 1. The Spark.
Centuries before the global financial elite coined the term edtech, the Indian subcontinent had already mastered the art of knowledge transfer. We are talking about a civilization that built the world's first universities, Nalanda and Takshashila. In this part of the world, there is a profound, almost spiritual value placed on education. In the modern Indian household, this ancient reverence translates into an unparalleled, almost fierce dedication. Parents don't just passively send their kids to school. They actively curate their intellectual journey. The market for education in India is driven by an absolute, unshakable faith that the right knowledge is the single, non-negotiable escalator out of the ordinary and into a better life. So naturally, the demand for that escalator was infinite, but quality supply, that was gravely bottlenecked. Access to genuinely good teaching was wildly unequal. If you lived in a Tier 1 city and your parents could afford it, you went to a coaching institute. If you didn't, you made do with whatever your school could offer. The information asymmetry was enormous. This was the catalyst for what would eventually become a global phenomenon. But before we get there, we gotta go back to the early 2000s. Our protagonist wasn't a silver-spooned Ivy League MBA grad with a venture thesis scribbled on a napkin. He was an exceptionally gifted engineer from a coastal village in Kerala. The son of two school teachers, Byju Ravindran possessed a savant-like ability to deconstruct complex concepts into simpler, bite-sized shortcuts that are easier to digest. It actually all began when Byju started informally teaching these shortcuts to a few friends in order to help them clear the CAT exam, the notoriously brutal gateway to India's top management institutes. He even famously took that very exam and obliterated it, acing it perfectly, twice, without even really trying. As word spread, and recommendations came pouring in, demand for his CAT prep classes exploded. Eventually, he wasn't confined to stuffy, fluorescent-lit classrooms. He was booking out massive sports arenas, like literal indoor stadiums, packed to the rafters. Not for a concert or a match, but for a math class. Thousands of students completely spellbound by a man projecting geometry and probability on a colossal screen. He stripped away the dreary, rote memorization that plagued traditional schooling and replaced it with pure intuitive logic. He made math feel exhilarating. He made it make sense. But this wasn't a business yet. It was just a man who loved teaching and could fill a room with people who wanted to learn from him. Eventually, in 2011, this grassroots momentum was formalized into Think and Learn Private Limited. The early days were purely offline, grueling tours across multiple cities with a small fee to cover basic costs. But then came the stimulus, the moment that transformed a highly sought-after offline tutor into a digital messiah. Byju's got its very first check in 2013 from Ranjan and Mohandas Pai, who ran the venture fund RN Capital. From this point forward, their trajectory was only towards achieving greater heights.
Act 2. The Illusion.
2015 was a paradigm shift as Byju's launched its flagship app. Suddenly, they weren't just teaching MBA aspirants. They had expanded to reach upper primary and secondary school students as well. Byju's completely rewired the way Indian children consumed education. It digitized the curriculum and gamified learning, wrapping dense physics and chemistry lessons in gorgeous, high production value animations. Complex equations were now interactive puzzles. Within months, the app clocked around 2 million downloads. By 2019, they even secured a landmark partnership with Disney to bring that premium learning experience to younger minds, starting all the way from kindergarten. With the entire K to 12 segment, that is kindergarten to 12th grade, effectively covered, they found themselves dominating a colossal, untapped market. And what a market it was! The country had about 250 million kids enrolled in school. The hunger for quality education was enormous, and especially the anxiety around competitive exams like the JEE and NEET was practically cultural, considering most families wanted their child to get into a top engineering or medical college. The competition at the time consisted of fragmented local tuition centers and early clunky web portals. Against them, Byju's felt like an elegant, premium necessity. Quite quickly, it had racked up strong capital support from notable investors. In early 2018, it achieved unicorn status, becoming the 13th entrant in the Indian ecosystem to cross the $1 billion mark. Metrics soared past 15 million users, heavily propelled by putting Shah Rukh Khan, a national treasure, on every screen to convince Indian households that Byju's was an absolute prerequisite for academic success. Yet, even with the $1 billion valuation, the company's most explosive phase was still up ahead. Because just 2 years later, in mid-2020, Byju's was crowned a decacorn. The latest investment from VC Mary Meeker's firm Bond Capital shot up its valuation past the $10 billion mark. When asked about it, Mary Meeker claimed,
"Endorsed by millions of students, Byju has emerged as a clear leader in education technology. We are excited to support a visionary like Byju and his team in their quest to continue to innovate and shape the future of education.
This was around the same time the pandemic crippled the global economy. But for Byju, it acted as the ultimate steroid. When India's 1.5 million schools shut their doors overnight, Byju made a move that in hindsight defined his public persona at its best. He made the app completely free for all students across the country. It was a genuinely generous call, and it gave the platform a jolt into the mainstream that no marketing campaign could have bought. By April 2020, the app reported a 150% increase in new users. By mid-year, it had become the only Indian app among the 10 most downloaded education apps globally on Google Play. This was category-defining growth because Byju was capturing a lion's share of all investment flowing into Indian edtech during this period. And when you're sitting on that kind of momentum, with that kind of brand recognition, and that many users, the temptation to translate it into an empire is almost irresistible. So by March 2022, Byju had 150 million registered users and 58,000 employees. Its valuation had climbed to its peak of $22 billion, surpassing Paytm to become India's most valuable startup. The capitalization table read like a who's who of global finance. Sequoia Capital, Tencent, the Zuckerberg Initiative, Silver Lake, Tiger Global, all throwing hundreds of millions of dollars at Ravindran. He was now a billionaire, and his company had become a household name. Their branding was inescapable. If you watch cricket, the Byju's logo was plastered across the chest of the Indian national cricket team. They were even sponsoring the 2022 FIFA World Cup in Qatar. They had even signed on football icon Lionel Messi as a global brand ambassador for their social impact arm. But here's where the story pivots. Because with all of that capital and all of that momentum, Byju made a strategic decision that would define the company's fate. He decreed that organic growth wasn't fast enough. He was going to acquire his way to dominance. The shopping spree that followed was by every measure spectacular. They dropped $300 million to buy White Hat Jr., a coding platform for kids. Another $500 million on Epic, an American digital reading platform. One of their biggest spends was $1 billion on Aakash Educational Services, India's most established offline test preparation chain with over 200 coaching centers across the country. In total, Byju reportedly spent somewhere north of $2.5 billion on acquisitions in 2021 and 22 alone. The strategy did have a logic to it, at least on paper. Byju wanted to build the world's single-stop education destination. But it's not that straightforward, because underneath that excited uproar, the financial engine was actually making a disturbing, guttural sound.
Act 3. The Crack.
The first sign that things were turning sour came from the living room of helpless families. To feed its monstrous growth targets, Byju unleashed a ruthless, high-pressure sales machine. Agents were reportedly pushed to trick and coerce low-income parents into buying multi-year study plans they simply couldn't afford. When parents pushed back on the high prices, sales reps offered a dangerous workaround. They partnered with non-banking financial companies, or NBFCs, to auto-enroll families into high-interest microloans. They were basically booking multi-year revenues upfront, but funding it with debt strapped to the backs of vulnerable customers. This aggressive sales push was supposed to guarantee profitability for the company, but instead, alarm bells were ringing due to the suspiciously major delay in financial reporting. Byju's audited results for the financial year 2021 arrived only in September 22, after an 18-month delay. When they did, they revealed uncontrolled bleeding, with around 2,400 crore rupees in revenue, but over 4,500 crore in losses. For every rupee earned, they lost 2. When the FY22 results dropped, this time 22 months late, the story was identical, but on a much larger scale. Revenue had doubled, but so had losses, largely due to some poor-performing acquisitions like the aforementioned White Hat Jr. The dream of a global edtech empire was in practice a portfolio of underperforming assets hemorrhaging cash. But bad unit economics aside, Byju's was simultaneously locked in a brutal fight over a massive loan. Back in November 2021, they had borrowed $1.2 billion from American institutional investors. Instead of a traditional bank loan, this was a specialized corporate debt instrument meant specifically to fund rapid global acquisitions without diluting existing shareholders. It seemed smart at the time, but after just 4 months, Byju's had already defaulted on the agreement, and the story took a wild turn. Lenders alleged that nearly half of that borrowed money had vanished, transferred to an obscure hedge fund operating out of Miami in an IHOP, a popular pancake restaurant. When pressed about the matter, Ravindran denied misappropriation, insisting the money had been moved to protect it from what he considered to be predatory lending tactics. While the legal battles raged across the US, the foundation in India began to collapse as the Enforcement Directorate raided the Byju's offices over suspected foreign exchange violations in April 2023. A couple of months later, Deloitte resigned as their statutory auditor, citing agonizing delays in receiving financial records. Following suit were 3 major independent board members whose simultaneous exit sent a clear signal to the entire market. But the real blow landed in September 2023, when the Board of Control for Cricket in India, BCCI, officially filed a claim against Byju's. As the title jersey sponsor for the Indian national team, Byju's had failed to pay around 158 crore rupees in sponsorship dues. Nearly a year later, in July 2024, the National Company Law Tribunal, NCLT, officially admitted the BCCI's insolvency plea. This was the final nail in the coffin. An interim resolution professional was appointed, the board was suspended, and Byju Ravindran completely lost control of his own company. Forbes, which had once listed him among India's wealthiest individuals, recorded his net worth at 0. The legal fallout continued to cascade globally. In November 25, a Delaware bankruptcy court issued a default judgment against Byju personally, holding him liable for over $1 billion in connection with the missing loan proceeds. He continued to deny wrongdoing and announced plans to appeal. Furthermore, just 2 days ago, on 27 May 2026, a Singapore court, after finding that Byju Ravindran had repeatedly failed to comply with court orders, sentenced him to 6 months in jail for contempt. With the trust deficit now absolute, the company seems to be locked in a terminal death spiral of unpaid vendors, mass layoffs, and frozen bank accounts. This shooting star that once promised to illuminate the perfect future for millions of children ultimately failed to secure its own.
Act 4. The Fade.
The company that was once the crown jewel of Indian startups was now just another entry in the corporate resolution process. By May 2025, the app had also been delisted from the Google Play Store simply because they couldn't pay their AWS bills. Aakash Institute, the only truly profitable asset in the portfolio, was sold off for parts. But the true wreckage was left on the ground. Thousands of employees fighting for unpaid salaries, and vulnerable parents and students trapped in expensive loan agreements, waiting for refunds that may never come. Today, the Byju story exists mostly in courtrooms. As for Ravindran, he continues to deny the majority of the allegations, claiming,
"I have always maintained that I acted in good faith and in the best interests of Byju's, its employees, students, and stakeholders. I have also placed on record that neither I nor any of the founders personally received any portion of the disputed funds, and that the funds were used for legitimate business purposes."
There are a lot of complex gradients in this story, and I don't want to flatten them. What I'd rather do instead is focus on the structural failures, the decisions and patterns that made this collapse possible, and the lessons we should carry out of it. The first and most fundamental lesson is extremely specific to the pandemic era delusion. COVID-19 created an artificial bubble for edtech. Parents who would never have paid for an online learning subscription were suddenly interested only because schools were closed down. Students who preferred classrooms were on the apps because they had no choice. The engagement numbers were real, but the underlying behavioral shift wasn't. The moment schools reopened, students and parents returned to physical learning, and the edtech boom unwound almost as fast as it had built. Byju's made the mistake of treating a temporary, crisis-driven surge as evidence of a permanent structural shift. They staffed up to 50,000 employees on the assumption that a post-pandemic world would look like the one they had just experienced. When reality reasserted itself, the cost base was completely out of proportion to actual demand. The second lesson is about the difference between building a business and buying one. Byju's acquisition strategy is what can be described as inorganic growth. The theory was elegant. Use capital to acquire adjacent businesses, integrate them, and create a single educational ecosystem that captures every stage of a learner's life. But the execution was a disaster. The cultural and operational complexity of managing multiple different companies, each with their own product, engineering, and go-to-market approach, was completely beyond what the company's management structure could handle. When you are buying revenue rather than earning it, you are also buying every problem that came packaged with it. The third lesson, and maybe the hardest one to sit with, is about the ethics of sales at scale. In the rush to grow subscriber numbers and justify valuations, the Byju sales team became infamous for their tactics. Current and former employees described a culture of relentless pressure and a mandate to close at all costs. Byju's grew its numbers in part by extracting money from families who could not afford to lose it, by selling hope in a context where every Indian parent is desperately anxious about their child's future. When a company's growth model requires preying on their anxiety rather than genuinely serving it, it has lost the right to call itself an educational mission. And the fourth final lesson is the most important. Governance matters more than valuation. At $22 billion, Byju was celebrated. But the governance architecture underneath that number was hollow. Financial statements were delayed by nearly 2 years. Auditors resigned. Independent board members quit. There were no functional checks on management decisions, no independent audit mechanism, no transparent reporting. A company that raises billions from institutional investors has a fiduciary obligation to those investors. When a founder treats that obligation as optional, the fall is not just financial. It destroys the very mission that made the company worth believing in to begin with. Byju didn't just run out of money, it ran out of trust. And in business, trust is the only currency that actually matters. Which leaves us with a thought-provoking question. In the modern startup world, have we become so obsessed with a company's financial valuation that we tend to completely forgo whether it's actually adding any sustainable fundamental value to society? And that's your study module wrapped for the week. No buffering, no missed deadlines, just the full lesson delivered. If you enjoyed this breakdown, make sure you're subscribed to the Flop Side so you don't miss what's coming next. But before we close the books, here's one last thing to sit with. South Korea's private tutoring culture got so extreme that the government eventually made it illegal for tutoring centers to operate past 10 p.m. To enforce it, they created actual patrol squads that go out at night, specifically hunting for students still studying and send them home. They even started paying citizens cash bounties to report any tutoring center breaking that curfew. South Korea didn't have a study problem. It had a study addiction so severe the government had to physically intervene. Similarly, India built Byju because millions of families wanted exactly that kind of edge, which tells you less about a startup and more about just how deep the hunger for education really runs. If you've spotted a structural flaw in the ecosystem that no one else is talking about, or have a controversial theory about the next big bubble, find us on Instagram at theflopside.podcast. I'm your host Priyanka, and I'm here with my co-creator Nandita. We'd like to thank you for hanging out with us this week on The Flop Side, where we show you the flip side of flop startups.